Are you someone who is self-employed and you have your accountant write off as many of your personal taxes as possible? Well, that's probably good for your tax bill, not so good for your mortgage opportunities. Now, if you don't want to be stuck sleeping under your desk or renting forever, then this video is probably for you. Thanks to remote work taking off, coupled with platforms like Etsy, Shopify, Amazon, 15% of Canadians are now self-employed. Now, if you ever tried to pitch a bank on why your company has a great trajectory, lots of monthly active users, and has great promise to do well, you're probably disappointed with the way that they look at your business. Now, as someone who is self-employed, you probably know the cardinal rule of working with customers. You have to speak their language. Now, with banks or mortgage lenders, it's the same principle. Although you may not agree with the way they look at things, you still have to frame things in the way they look at things. So getting a mortgage as someone who is self-employed has a lot of nuances, but the number one thing I want to focus on today is how they look at your income. And you're going to find out that it's a trade-off on how much income tax you pay personally, and also, of course, how much mortgage eligibility you can go for. There is a happy medium, so let's dive in to find what is your sweet spot. Do you want an estimate on how much you qualify for today? Well, all you got to do is you take a 2-year average of what you declare on your personal T1 taxes for the last 2 years, right? So when you do that, in this example, we're going to say that that equals $175,000. A simple rule of thumb to quickly see how much mortgage can you qualify for, well, look. Assuming you have 0 debts, and that's personal debts, you multiply that 2-year average by 5. Okay, so that's that 5x multiple. So in this example, you've got $875,000. Okay, that's great. Now look, if the home you're looking for, when you look at your down payment, if the mortgage you need is less than $875,000, well, guess what? You can write off a little bit more and save on taxes. But if the home you're looking for ends up being more mortgage, then if you write off too many taxes, then you've overshot it. So what's the happy medium? A simple rule of thumb, if you want to know how much mortgage you can afford, is you take a 5x multiple of that 2-year average. This assumes no debts. So if we have an average now of $875,000 of mortgage eligibility, well, that's great. So let's say you're looking at homes, and the homes that you need, you do not need $875,000. You need a lot less, which nowadays is rare, but let's say if that's the case, great, you can actually write off a bit more of your income so that 2-year average goes down, and that way you save on personal taxes, right? Now, be aware that a lot of times there's bidding wars and you have to actually go higher. So if you've declared too little taxes and you need more mortgage, well, then you're in trouble. So just be really cautious about this, the special balance. For example, let's say you are looking at a home worth $600,000, okay? You have $35,000 as a down payment, which means that you need $565,000 as your mortgage. Okay, so as we said before, maybe you claim a little bit less since you don't actually need all of that income claimed. So if you divide the $565,000 by 5, remember 5x a certain amount of income equals about how much mortgage they will lend you. So in this example, you have $113,000. That's your sweet spot number that you need to claim from your 2-year average to afford just enough for that $565,000. Now, if you remember our example from just a minute ago, we were saying that you made $200,000 last year. Now we're saying you'll need $113,000 to claim of income. Well, I mean, what's that impact on your personal taxes? I mean, if you look at the screen here, you can actually save about $26,000, assuming that's where your tax bracket is. So that's a good amount of money. So it's tempting to definitely claim less income, just enough so you can get enough mortgage. Now, remember I said a moment ago as well that if the house is more than you think it is, you're kind of in trouble because it's hard to go back and then reverse how much you claim. Although it technically is possible, but it's very difficult, right? Now, one thing to keep in mind is that with a lender, remember, they'll take a 2-year average, assuming that the last year's taxes are higher than the year before, right? They'll take an average. Now, we claimed $113,000 this last year, If a lender sees that the most recent year is less than the year before, they don't take a 2-year average. They take the less of the two. I mean, they're always working against you. So be extra careful. If you're claiming 113 is now your effective 2-year average. So again, it's this careful balance of calculating how much mortgage you want to have as your ceiling and how much you save on taxes. Now, one thing to note about taxes as someone who's self-employed, usually the tax deadline is in June, okay? So if you're in the first half of like this calendar year, and obviously you're looking at the 2 years before, right? And you haven't claimed last year, I mean, you still have time to follow the last exercise and be like, how much should I claim for last year before my June deadline, okay? That's the one thing to consider is, remember, you declare taxes a little bit later than people who are employees. So if you're in the first half of the year, you still have time to work through this exercise. Now, here's a question I get really often, and it's actually a really interesting hack. Now, again, you're in the first 6 months of this year, and let's say last year wasn't so good. So you think to yourself, when I claim my taxes, no matter how many I claim, it's not going to be a high number. But remember, before you submit last year's taxes in June, you're at this point averaging out the 2 years before, okay? So if you actually have to buy a home right now and the last 2 years before last year were pretty good on a 2-year average, then what you can do is you can submit to the lender the last 2 years before this last one, right? So you have a higher average, but keep in mind, your home must close ideally before the June deadline, okay? So if you're like in like April, May, you put an offer down and you're moving in around, well, before June ideally, beyond then it becomes a gray zone, you can claim income from, again, the 2 prior years with a higher average. Talk to your mortgage broker about it, but there are still ways to basically not have to talk about last year since you have this privilege, being self-employed, of declaring your taxes 6 months into the next year. Now, what if your business has only been around for 6 months to a year? I get this question a lot. Is there any hope to getting a mortgage? Well, yes, and there are a couple programs. So first and foremost, if you have under 20% down payment, which means you have an insured mortgage and there'll be a lot more scrutiny on your file from the government, they actually still have a program where based off your prior experience, either in a different job or a different venture, if it's in the same field, they might make an exception on not having to take a 2-year average, but taking a 1-year average. Now that totally depends, consult your advisor, but that's one thing to keep in mind. Now secondly, if you have especially over 20% down payment, you're eligible to work with alternative lenders who are much more flexible. I mean, one of the more famous programs right now is the 6 months bank statement program. So literally, if you're having an amazing last 6 months, this could actually be if your business has been around forever and you've had a really good last 6 months, they'll look at your bank statements of the last 6 months, see the revenue inflow in your statements, and they'll extrapolate it by 2. So if you were making, let's say, $50K in the last 6 months alone, you're on pace to make $100,000, and then they'll use the 5X multiple rule on that. Now, one thing to keep in mind is that alternative lenders are a lot more flexible, so that 5X becomes 6X or 8X. Like, they have a lot more flexibility on your debt to income ratio. That's how they look at your mortgage. So yeah, lots of options if you're under 2 years, all depending on your down payment and your kind of business. And one last consideration before we wrap up is, look, as entrepreneurs, do not like to be told no. We like solutions, and I've hopefully given you a handful strategies on how to kind of position yourself in your mortgage. But keep this in mind. You may not be ready for a mortgage. The expenses may not make sense. It might be too much stress. So it's totally okay to wait a year, but at the very least, understand how you're going to be qualified. What are the rules of the game? So you can start to position your expenses in the way that you claim income on the way that's going to be most favorable either now or in the future. To conclude, look, number one, you've got to have foresight on how lenders qualify you. So we talked about how most lenders take a 2-year average of the income you have personally declared. So when you look at that 2-year average, and you also think about what the down payment is going to be for yourself and how much mortgage you need, you've really got to do a bit of mental math and work backwards. And of course, if you haven't been around for 2 years, you've only been around for 1, or the last year has not been great, but the last 6 months have been awesome, Then again, there's other programs as well where they can extrapolate your income. Those are all possibilities to consider when you're getting a mortgage as someone who is self-employed. So what's your next step? Well, do you know what you declared on your income the last 2 years? Start with that. Figure out what is your 2-year average right now. Talk to your accountant, and then of course start looking at listings and work backwards. And remember, if you have over 20% down payment, that 5x multiple calculation, that rule of thumb can actually be 6 to 8x because you're extending amortization period, which is the lifespan of the mortgage, and of course you are having access to more lenders. So just do a bit of math, know where you're shooting, and you're going to be in great position to acquire a house when it works out for you. I really appreciate your attention. Look, if you learned something that was useful today, please make sure you are subscribed and alerted for the next video. And fellow entrepreneurs, as always, keep leveling up your living.